Our next speaker who's going to bring us up to date on some of the personal tax information out there is Barry Shapiro, Witham Smith and Brown, and
I don't know how to work this.
Don's going to show you how to work it.
I'm not
I'm not going to show you how to work it. It should be on there, right?
Which thing would you like brought up first?
I don't know, whatever
We
we
got,
had.
we got 2 real estate items, social media items.
Social media.
Social media.
Thanks.
Sure.
And then we'll go to the other thing under the real estate.
Okay.
Thank you very much. I gave Jim a little headache today because with the issue of the holidays and the issue of what we're all fighting on September 15th, I really didn't get my data to him until today, and that was only because I could ask our marketing people to help me out. But I wanted to talk about something which has nothing to do with taxes, and that's social media. And I think that's the way we're going as CPAs, and I think we should be involved with social media. Can you move it up and down?
All you got to do is right there.
Right. I think it's important, and I think that us acting in the capacity of advisors need to get involved with social media. It's very important, and one of our own CPAs here, Gail Rosen, is almost like an expert in it, from what she tells me. But I think it's great. I'm kind of weak in it myself, but I think it's important for us to get involved, and so that's why I put it on the web. And I would hope that when you get back in your offices, print it out, take a look at it. The lady in our office, who's Sarah Sorelli, she's well known for putting out social media throughout the country, and I think it's a coming wave, and I think that us as CPAs have responsibility to get involved with it. So that's why I had it put up. We'll go to
Which one of the real estate ones?
yeah, before you do that.
Is this okay?
Yeah, that's fine. That's all right. Before we get into the real estate, and I'm not going to blow on Howard's horn, but there are a couple of things that I thought were interesting, and I know he's going to cover a couple of them in detail, but I want you to be aware of, especially IRS expands the relief program for employers with misclassified workers. Howard's going to go into more detail, but I think it's an area that we have to pay attention to. I'm also on the State Tax Committee, and we go down to Trenton. It's one of the big areas, and it's one of the big areas Department of Labor is starting to look at, as we all know. And so I think that's an area that we have to take a look at. And one of the other things, I get a lot of questions about from different companies. So what's the per diem rates for our people moving in different areas? And I refer them to publication 1542 from the IRS, which covers all the locations and the per diem rates. So I think that's an interesting area. And hopefully, if you have that issue, please go into that area. And the other thing that just came out, most of us who work in tax are aware of it. It actually comes into play on January of 2014, which is the final regs on proposed tangible property was passed, and I think it's going to have an effect on a lot of clients, especially some of your smaller clients. So please take a look at that. It just came out the other day, finalized, and again, it takes effect on January 2014. All right. Does anybody know the answer to that one? All right. We have a Schedule C. All right. I have a doctor. He owns his building in which he pays rents to himself. Can he take that deduction on his return? Anybody have an opinion?
Schedule C?
Huh?
You said Schedule C?
Schedule C.
Him as an individual?
Yep.
More than
No.
half his time is
I don't
spent
think
in
so.
real estate.
Right.
750, yeah.
No?
And he
Can't.
documents
So
750 hours.
that's what he has to document. Thanks, Howard. But that's an important point because a lot of people, and especially a lot of accountants I know in our area, unfortunately, Monmouth and Ocean County, they have small accounts, one-man individual doctor owns his building. They've been taking the deduction for rental and not having set up an LLC with more than one person. As the owner of the real estate, the IRS obviously is coming in and disallowing it. So let's pay attention to that and make sure that there is a separate entity set up with more than one person.
Hey, Barry?
Yeah.
On that, by the way, there actually is a, I don't know if it's a case or ruling about a husband and wife, though. If it's
Right.
between a husband and wife, you can actually do that on the same return, but there has to be different ownership in the business and the home.
Right.
It's very rare.
Yeah, the wife would have to own it separately from the husband, and
Correct.
obviously, no, we can't advise them to do that because of a little thing called divorce. Move on to the next one.
Next real estate one?
Yeah. Next one. No, that's one we just did. Tax plan, yeah, go ahead. This one, yeah. This is the courtesy of Dave Springsteen from my office. It's his actual data that we had in our firm-wide tax seminar. Some of the areas I'm going to cover is tax rates, strategies, obviously education, investment planning, business tax planning, retirement, estate planning I pulled off because obviously we have somebody who spoke about estate planning. All right. Individually, you got to remember that our rates are going to change. These are the tax rates. I'm going to flip through them to get to. Traditionally, our tax, the alternative minimum tax, the 3.8% tax on investments, and you know we're going to be stuck with the 3.96% and maybe a 5% incremental rates sometime. Our tax brackets, all right, 10, 15, 25, and 28% were made permanent, and 33 and 35 rates were made permanent. Now, our thresholds to determine work on the 3.8 to the 39.6 are single 400,000, head of household, and you can read it, I hope 425, married 450, and married separately half 225. Also, one of the things we got to think about is capital gains rates, because obviously it's now moved up to 20% and could be 23.8% depending upon where we stand with the additional tax. And remember, one of the things you might want to think about here is if you have children, somehow moving some of the income to the children. The first $2,000 can be at the lower rates, anything above that, obviously depending on their age, and it goes up to college age at 24 now, would be at the parents' tax rates. Phase out of personal exemptions now. It's one of the things we have to worry about, especially with our high income earners. Beyond, represent a lot of people who make sizable W-2 income. They're going to phase out pretty quickly, and so we have to watch out for that. Besides the phase out of that one, we have the phase out of itemized deductions. For instance, I have physicians who make $5 million on their W-2. Right? They're going to lose basically 80% of their itemized deductions, except for casualty loss or medical, and they won't qualify for medical anyway. So it's one of those things we have to pay attention to, and hopefully we will do that. And it's important that we look at these things right now, because maybe we have to adjust some of their estimates if we didn't take that into consideration when we set up their estimates back in April 15th when we prepared their tax returns. Phase out of personal exemptions would be basically $425,000. They're going to be phased out, so you know it gets there pretty quickly. It's the old rules, and I don't know about your clients, but I know mine don't pay attention to anything that we tell them. And I think it's going to be a headache for all of us, because come April, if we have not adjusted their estimates, they're going to ask why. Why am I paying the tax? So please pay attention to that. The phase out on that, on itemizations, can go real quickly. You want them to fly below the radar, which is 450, the 300,000, and 250. Strategies, you know, maximize your exemptions, plan around the kiddie tax. It's important that we look at that. Health insurance maybe, bunching deductions, pay estimated state tax early, all the old things. The question in my mind with my people is, I know they're going to be phased out, so why pay the state early? I usually tell them don't pay until January 15th, and we go on with that. Donate appreciated property or optimize investment interest expense if you have that situation. Hopefully we don't have too many people who have divorce issues. I just had one yesterday, and this will tell you how things work in this world today. Husband and wife married. They divorced in 2013. The wife goes back and files single return for 2011, 2012, although the divorce decree indicated that they should file married. So now we have an issue with the IRS because the letters for 2011 are ready to come in, and I anticipate 2012 will come in. And it's one of those issues, you're dealing with the IRS on these kind of things, it gets very sticky. Don't forget our old friend, AMT, right? 28%, 26%, 28% on the amount of taxable income above the exemption amounts. The exemption amounts, obviously, we know are 51,900, 40,000, 400,000. So obviously all our programs hopefully work out well. Although I know this past tax season I saw a lot of blurbs on our web which indicated there was a lot of problems with some of the software, so hopefully we don't have that problem. Again, shifting income is a way of doing it. Probably consider your plans for the near future, but again, I'm always weary of transferring a lot of assets to spouses because of the divorce issue, and I've been involved with many years where that comes into play. Take advantage of employers' Section 125 cafeteria plan, 401k plans. And by the way, do you know that if you're over 70 and a half and you're still employed and you're in the employer's 401k plan, you don't have to take a distribution. There's a revenue ruling on that. So be careful in those areas. Thank you, Howard. One of those things you obviously can consider is separate filing. I've never found that out to be useful, but who knows in this area now with if we can segregate income, depending upon if we add them both up together and they get to 500,000, maybe there might be some way of getting some benefit by filing separately. All right, remember IRA distributions, age 70 and a half. Make sure they do the right distributions. There's a calculation that you can do, and I find that I check that sometimes because I find, especially with several brokerage houses, have made some errors even though they're coordinating and they're the administrators of the IRAs. The education stuff, obviously I'm just going to blow right through it, but you remember the different rules. 529 plans obviously are great for putting the money away and for saving some items for college education. One of the things I've done with a lot of my clients, especially those who are more on the wealthy side, I've had them actually give gifts to their parents and have the parents then donate in $60,000 to put in the 529 plans so that because if they don't die within the 5-year period, it's not included in their estate. So that's something to think about. Dividends used to be very great because we could say, okay, we're going to invest in a lot of stocks with dividends and pay it 15%, but if we're going to be in the 3.8% issue, it's going to be a problem. Sale of homes, we know about 500,000 if joint or 250 single. You'd be surprised, I still have people call me up and they say, I'm selling my house, can't I defer my gain on my acquisition of my second house? So, I mean, a lot of people are not aware of the laws. Investment planning is going to be important this year and for the following years, so that we try to keep out of the passive income areas. And it's important that we maybe look at some tax freeze, even though some of that might be taxable down the road. I think it's going to be the program we're going to see next. Mutual funds may be some kind of tax benefit. To be honest with you, most of my investments are in mutual funds, and hopefully I'm not going to be hurt with the 3.8% in this year. Possibly like-kind exchanges might come into play. You just got to be careful that you meet all the rules and regulations. And then we'll go to that, AMT planning. Maybe what we want to try to do is have some of our dividends spread out if we have multi-children, give them some of the investments, and that lower brackets, if they're under $2,000, be no tax, so we move right on with that. We talked about S-corps. Let's go. Trying to get to a certain area. Do me a favor, Tom, let's go to 3.8, the next one. The other real estate one. Oh, sure. I handed out an additional handout, which is not here, which talks about the 3.8 net investment income and how to minimize. I think there's some good ideas in here. You got to remember all the limitations, the new terminology we now have, NIIT, MAGI, and I think if you take your time to read it, use it as an example when you're working with your clients, I think it'll be helpful. And that's why I printed it out today. And when I was thinking about coming in, and I thought I'd pass it out to everybody, so at least you'd have something that you can refer back to it. And when we talk about real estate, obviously, it's still how can we be a professional? I mean, the question we used to have was that we wanted to be professional, and then we made the election to put all of our real estate together so that we can net our profit with our losses. And the issue we're going to have in the future now is that can we meet the active test? So if we can meet the active test, then we're going to eliminate the 3.8%. And if we eliminate the 3.8%, we're doing service to our clients. A lot of my clients have come to me and said, well, what can I do? So what we've been trying to do is that we've been trying to set up LLCs with basically family members. And that, although we have one person active, we have passive other people. We're trying to figure out how we can put some of their investments into an active situation. So that, one, that if we can make it an active situation and it's not a pass-through entity, then maybe we can do some things for retirement, we can do some other possible things, and then secondly, we can hopefully have active income so that we don't get caught in the 3.8% additional tax. And I think that's one of the things that we have to think about and that we have to provide to our clients because they're coming to us for advice. We are supposed to be the know-all in the area of taxation, even though a lot of us maybe only do certain areas of taxation. So I think you got to look at those situations, each one separately, and then try to figure out how to determine how we can move some of these investment type things into areas where we can try to make it active, because it's going to be important to do that. I'm involved with a lot of surgery centers, and there's always been a question in surgery centers as to whether or not the doctors who are invested in these surgery centers, the income generated out of that, whether that is active income or self-employment tax. If you go to all the accounting firms in New Jersey that handle surgery centers, 50% handle them one way and 50% handle them the other way. Some of them handle it as active self-employed, and others handle it as investment. So now people who handle it as investment are rethinking the situation, because what happens there is probably these people are in the area where they're only going to pay additional Medicare tax. So you're still saving them some money instead of paying out the 3.8%. So I think that's an important area. With that, I'll take any questions that you may have.